As we shift into the technical detail and how to stay calm because that underlying depth of knowledge is there, tell me what are some of the things that you see there that folks start to put around them as far as systems and advisors. What are some of the things you see that the folks who are doing it well have around them?
Yeah, so shifting into the technical detail, the founder journey is basically from the beginning when we started with the financial habits. That's like, hey, I'm willing to take a look at this. And then you shift into the planning of the scenarios. And that's now, okay, we have the scenarios, we know what we're going to do, when we're going to do it. And then you shift into knowing the more technical details, which is actually understanding the levers that you can use. Now, I'm not saying the founder needs to be an expert in all these scenarios. They should still definitely rely on professional help, like their CPA, their lawyer, financial advisor or planner. Maybe they have a fractional CFO as well. They should still rely on those professionals as a primary, but they should also have some technical knowledge so that they understand the levers that are being used, because it'll put their mind at ease and give them more financial confidence in their personal life and in their business. So three categories I would focus on in terms of having the technical knowledge of is understanding how equity works, like vesting schedules, dilution, preferences of the different types of equity, and understanding taxes at a basic level, knowing how different income sources are taxed, like salary versus bonuses, how their equity could be taxed too when they're taking stock options, and how liquidity events as well will affect their taxes. And the third thing I would say they want to have a technical understanding of is timing. Two founders could do the same thing, like exercising a stock option, and if they do it at completely different times, they're going to have a completely different outcome. So just understanding the timing of how the different levers, when the different levers are pulled, can change their financial situation immensely.
Absolutely. And I know one of the scenarios we ran into recently is depending on the significance of the ownership stake, there may also be some limitations as to how much they can actually execute as well if they're one of the major equity holders of the company.
Going back to the example of exercising stock options, do a little math problem really quick. If you're exercising stock options, you have this thing that's called a spread. So you have a strike price that you're allowed to buy the stock options at as a holder of these options. And then there's going to be the valuation price. So there could be advantages on the timing front of exercising stock options early versus late. Like some of the advantages early might be the taxation concerns, whereas some of the concerns could be on exercising it early is, since you're still an early stage business, there's still a high probability of failure. Whereas exercising them late could come with tax consequences, but then you have more certainty in the business so that you know that when you're exercising this option, like you're getting to buy it on the cheap. Sure, you got to pay some taxes, but now you have a more certain equity, even though it's higher concentration. So just a quick example is if you're doing it early, the valuation price is $3 per share. You have a strike price of $1 per share, and you've got 10,000 shares. That's $20,000 of spread for buying those. So that would be recognized as ordinary taxable income. Versus now, if you do it late, and let's say it's $25 per share at the valuation price, still that same $1 strike price. Now it's $24 per share as that spread. So now you're going to, on 10,000 shares, you're going to realize $240,000 of ordinary income tax.
Yeah, we'll have to be very mindful of that. And I think as well, we chat about dilution all the time and how folks can, especially when they're chasing those first dollars, those first investors, there can be a tendency to give up too much on the front end, which now sets the baseline for future investors and can very quickly get you maneuvered out of a controlling interest in the business.
Right, and those options might be a way to get back in the game.
True, very true. The other piece I know that I appreciate as well is we talk about having those right professionals around. And the analogy I like to use is I'm fairly handy with a pair of pliers, but my dentist doesn't let me run around loose in the back of his practice. And so the same kind of thing is true as having those great CPAs, attorneys, financial advisors along for the way to say, how can we do this as efficiently and as pain-free as possible?
Yeah, it can also be good to listen to your investors. Like some of your investors might be your advisors too. Not necessarily like a financial advisor, but they might be a business advisor. And it can be good to listen to them as well. I know that several investors, you're talking about dilution, several investors are wary of founders who are quick to do secondary sales at the wrong times because it just shows inexperience and it shows a little bit of financial desperation in a way because they might need the funds for maybe they upgraded their lifestyle too early. But what we'd more like to see is when founders tie their secondary sales to milestones. So to give an example, I have a friend that has a furniture resale company. He started out just by doing couch flipping. And it's kind of remarkable, as you wouldn't think that's like a huge industry, but furniture resale itself is a multi-billion-dollar industry. So he actually is able to do quite well for himself. But let's say that he decides a milestone before he shifts into full furniture resale on just the couch flipping side is he wants to capture 5% of that market share. Maybe that's what he feels like is up for grabs. So to make numbers easy, if that's a $100 million industry, then he's got to capture $5 million of annual recurring revenue. And when he hits that milestone, that might be a good time to dilute himself a little bit and do a secondary sale so that he can diversify some risk away and can invest in other things. So if he wants to sell 5% of the stock and he's got a 10x multiplier on his valuation on the annual revenue roughly, once again, make numbers easy. That $5 million annual revenue turns into a $50 million valuation. If he diversifies away 5% of his stock, then he's got $2.5 million at his disposal to deploy in other areas so that he can have a much more well-diversified personal financial plan.
Yeah. I think the thing as well is that's also a great signal to outside investors as well to say, hey, look, one, this is someone who's disciplined, but two, they set a target and were able to achieve it. That's a nice boat for follow-on dollars and on the investment side as well, because that's also something we see a lot of where folks do track the ones who are investing and see how many follow-on dollars come in behind the initial. That can be a great sense for the health of the company and the leadership as well.
The optics are important because when you sell smaller slices at milestones, selecting those milestones are also important because it might be the time when you need to make some sort of pivot, whether it's, okay, you captured that 5% market share, but now you need to re-strategize to figure out how can I capture more of the market share. Maybe I only captured what was up for grabs, but now I want to shift into how do I capture some of my competitors' market share. Or maybe that's all you can get in that market, and now you need to identify new markets that you can naturally push into. Or, hey, nothing's working, let's just completely pivot. That's also always an option.
Yeah, and I think to your point there as well, taking some of the cash off the table might be a great opportunity as well to say, is there new talent acquisition that we need to pursue because the things that God is here won't continue to carry us forward. So that could be another great recognition signal as well. Say we're taking some off to reinvest back differently in this or other businesses.
Yeah, and it all goes to show that when it comes to these decisions, that the calendar is actually a lever itself. So like I said before, if two founders make the same decision, but they do it at two different times, they could have a completely different scenario that is the outcome of that. So it's just good for founders to know what all the levers are. They don't need to know exactly when to pull them. We can kind of plan that out as the conversation develops. But it's just good to know that the levers exist and what happens when you pull it.
Yeah, and I think one other last piece there as well that can be really helpful is, let's say if you and I are the two founders together, it's probably worthwhile to communicate, when we may be exiting at the same time. Because let's say you have a meaningful interest and all of a sudden you sell 5% of the shares. Well, and I want to do the same thing tomorrow. I may be looking at a much lower price just because there's been a material trade that's happened in the course of business. So it can be worthwhile to maintain harmony to share, here's the plan. Should we move in tandem or sequence these at different times?
That's just another thing to bode well for the business agreement and the buy-sell agreement. Make sure that you have some of those in place when you have co-founders to make sure that if they have the option to do it, you have the option to. Just want to expand on like each lesson a little bit in terms of how specifically we can help. And so starting with lesson 1, developing the healthy money mindset and habits. One thing we can do is organize your personal and business financial life into a financial dashboard. Make sure that you can see the whole picture. And then we talk about that rhythm. We have a rhythm of check-ins, make sure that quarterly or semi-annually that we're reevaluating the plan, making sure everything is going right, or if things are going wrong, how we're making adjustments on the financial side. So once again, make sure that touch point's quarterly or semi-annual, and we're not just being reached out to when it's during crisis moments, making sure that that cadence keeps true. And the last thing we can do is ongoing coaching as well to make sure that the decisions are sound and not just a rash decision made because of whatever situation's happening at the time.
Fantastic. Well, Alec, as always, enjoy our conversations and your insights. And I know our listeners and viewers are going to be enjoying that as well and thinking about how they can apply that. And so please feel free to reach out to us. So we have a lot of insights and tips and frameworks that help guide you as you think about your expansion and exit strategies. And we look forward to sharing more of that, and especially with our content around how to exit like a billionaire. Give us a shout, and we look forward to catching up with you soon.